I'm Michael Yorba. Thanks for joining with us. All right, I'm here with Tom Weickgenant. He is a Chief Tax Strategist with Economic Strategist, and he's also an enrolled agent. Tom, welcome back to the show.
Well, it's good to be here. Thank you.
Glad you're here. All right, there's lots of changes going on in the tax code, and I want you to bring those things out. Let's start with the big ones that you really notice and work our way down from the top to the bottom, okay?
Okay, well, the big one has been that the tax rates have been expanded, and that basically provides a reduction to a lot of people more in the middle range, because used to be you would take a big jump to the next rate, but now because the tables have been expanded, that climb is a little less steep.
All right. Now that means that Middle America, unlike what we're hearing on some of the regular broadcast news, is really getting the benefit of this tax change, and the upper 1% is actually getting hit a little harder. Did I get that right?
Exactly. They got an increase in their rate at the top end, and plus they got a surcharge, about 3.8%. So they really got hit the hardest of everybody.
Let's dig into that a little bit. What else about these tax changes that you've learned this year? Because I understand that they're a little bit more complicated than they were in the past. So what else does the public need to know in order to prepare themselves to take full advantage of these new code changes?
Well, in some respects, it's a little bit easier because less people are going to be itemizing because they've increased the standard deduction. And for married filing joint, it's a $24,000 standard deduction, just about doubled. And same thing for if you're single, it went up to 12,000. And the problem with that is it's kind of like smoke and mirrors, because they also at the same time they removed the personal exemptions, which is was $4,050 per dependent per individual. So you're married filing joint, there's just the two of you, you lost $8,100, and you might have increased in your standard deduction, but so you really kind of lost.
What about business expenses?
Business expenses, well, a lot of depreciation, the bonus depreciation has been increased to 100% bonus for new or used property for 20 years or less of life, and so that's a big deduction and can add up fairly quickly.
Now, there's some parts that we need to make sure the employers know about,
Yes.
that have been changed, and if you don't make them know, then that's not going to work out.
That's right. They need to be well informed as they go through their year and their budgeting processes. The other thing is the corporate rate came down to 21%. It was a graduated rate up to 35%, which is really the highest in the industrialized world.
Right.
Now they're down at 21, which makes American business more competitive.
Is it a big edge relative to the other countries out there that are applying this corporate rate?
Yes, I mean, it is a big advantage now that the U.S. has. It's become more competitive. It invites investors, and so it has really stimulated our economy a lot because they've done more hiring because of the depreciation rules and many other rules, and so the employees have actually benefited from the changes.
Okay, what else has changed?
Well, one thing that changed during the year is right when the tax cut came through, the government adjusted the tax withholding tables, and they reduced them so you would be withholding less to account for the lower rates. And so instead of waiting till tax filing time to get your refund, people had more take-home pay during the year.
All right, now that can be a little misleading when it comes to the tax, the end of the year, right?
That's right, exactly, because what you hear in the news a lot is they're saying refunds are down this year. Well, that's because they didn't overpay quite as much.
Now we're starting to get into tax planning and how to do it properly, so that you're not really missing the boat on how to take advantage of this. Explain that to our audience.
Right. Well, part of tax planning is making sure your withholding is set properly.
Right.
You don't want to really come up really short when it comes to April 15th or October 15th, whichever the case may be, but you also don't want to come up with a big refund, because that means you've just given an interest-free loan for over a year and a quarter.
Let me drill down into that. Give us some tips on how to do, or at least set up the proper tax planning so that you're not in or behind the eight ball on this.
Well, you just want to make sure that you kind of know what your income's going to be,
Right.
and you have your exemptions. You know what your average standard deductions might be if you itemize, and you can just do a calculation. You have your tax practitioner calculate it for you, and he'd be glad to do it.
Okay. What else has changed?
Well, there's another new thing out there called QBI,
Okay.
because the corporate tax rate changed down to 21%, and yet there's much of small business. They're sole proprietors, they're partners, they're in partnerships, LLCs, subchapter S corporations, so they have flow-through income. And in order for them to benefit from that lower rate, if they qualify, they'll get a 20% deduction. So that's a big thing.
Yeah. What was it before?
They didn't have anything before.
I wanted to make
That's
that
new.
point. All right. Now, is that going to affect all businesses, or is it really going to center in and be the biggest impact on certain industry sectors or certain revenue streams?
There's quite a few that are like professionals, like accountants, lawyers, doctors. They have, and a few others that have severe limitations, but for the most part, it affects most businesses. It's quite an intricate calculation.
Now, we were chatting before the show. There is a lot of stuff that you have to pay attention to, and you're going to get confused, or some people, if they're not really schooled on how to use the tax code to your benefit, they're going to get confused and they may not end up getting the benefit of these changes. Give me some for instances in some of those cases so that people can actually get the full benefit of your knowledge and what you're bringing to the table.
Well, they basically need to know, say if they're in business, they need to know if they are qualified, get that QBI, and how to calculate that. And also if they are, say if they're a medical doctor or they're an accountant or lawyer, and they want to take advantage of that, well, there's ways to get there done, because QBI is calculated on taxable income, not adjusted gross income. So there are moves you can make to maybe bunch up your deductions, charitable contributions, for instance. That increased from 50% to 60% allowable. So they can bunch those up and get their taxable income down so that they can qualify for the QBI and things of that sort. So it takes a lot of planning.
It does, and it takes the right people to know the real rules as you get into even the 600 numbers, right?
Right.
Now, what else has changed? Is there anything else?
Well, those are really the main. There's a lot of changes within those changes. One other big change that a lot of people will notice is that if you have unreimbursed employee business expenses, those are no longer deductible. So you may want to talk to your employer about that, because they may not know, and all of a sudden you end up going to the take your taxes in and say, oh, sorry, you can't use this anymore, yet they've paid for them all. They're legitimately should have been reimbursed.
Now, you'd mentioned before, and I think I got this correct, but there's something that changed with the distributions. Is that correct? Did I get that right? In regards to deductions being able to be made versus how they were calculated prior to the tax.
The standard itemized deductions? Yeah.
Distributions is what I meant to say, not deductions. Is there any changes on distributions from revenue streams that you've got going on? Or is that pretty much the same?
That's pretty much the same. Those distributions, though, are subject to that QBI if you qualify.
That's what I was getting
Yes.
at. Okay, so you really need to know how to qualify for that QBI.
Right. If you qualify for it, that's 20% right there.
Got it. Tom, thanks for being a guest on today's show.
Sure.
A wealth of wisdom that always comes out of you. I learn something new every time you show up.
Well, it's great to be here. Thank you.
Pleasure. All right, you've been watching CEO Money with Michael Yorba. Thanks for joining with us. Like us on Facebook, follow us on Twitter, subscribe to our YouTube channel.